All right, everybody, welcome back. I'm going to finish out this kind of, tutorial on a very, very simple investing strategy. So we made it through the 1970s. Let me pull up that spreadsheet that I made. So just kind of giving a brief overview of that video previously. So we did find that the 21% one-year return was much better than the market's kind of expected 9% return when all you do is simply buy the SPY, the S&P 500, after RSI goes oversold, meaning it goes below the 30 level, and then goes out of the oversold, meaning it goes above that 30 level. So with just that simple strategy, we were able to do better than double of the S&P 500's expected return. So that was the 1970s. Let's go to the 80s now. So the 70s were kind of, that decade of inflation. Didn't really see some great returns. Now let's go to the 80s and see how things compare. So September, that's 9, so 6 is 3, so that takes us to March. So right here, so we'll call it negative 4%. And then our 1 year 81, and then our 1 year return 82 September. That is 3%. Let's look at the 5 year return. Sorry. Alright, 86. September is going to be a good one. We'll call it 97%. And then finally, let's go to 91. September. We get our 10-year return. And there we are. So let's call that 224. So that's the best one we've seen so far in the 10-year. All right. So going back to our chart, we'll take that one off. So then we go through 82, we go through 83, no oversold readings, 84, no oversold, 85, 86, nothing, but then we get to 87. This is kind of when we had that flash crash of 87. This is Black Monday. So let's see, let's do October, so that's 10 plus 6 is 4, so April, and here we are. So let's call that 4% for our 6-month return. What is this? This is 10-87. And then let's see our 1 year return. So 88 October. Call that 12%. Our 5 year return. So 92 of October. Let's call it 66%. And then finally our 10-year return. So 97 October. Oh, it's gonna be a good one. $179. And then finally we made it to 87. And we had that last one. We made that final dip down for the bear market reverse. So let's see, December, so that's 6 is June 7th of 80. So that's a good one, that's 12. That's 12-87. Let's look at our 1 year return. Our 5 year, And then finally the 10 year is going to be December of 97, which is right around my birthday. And there we go. So, ooh, great one. That was 304. So just kind of taking a quick look. So all of our 6 months returns, the average was 4%. And then we only saw one negative return, and that was in that 6 month of 81. Other than that, all of our returns were positive, which is what we want. Again, looking at that 1 year return, that was right around the market average. So not as great as in the 70s, but still pretty good. You know, you're matching the market returns without dividends, so that number is going to go up a little bit more. And then once we get into that 5 year and then that 10 year, we start to see much greater returns than our average 9%. So as you can see down here in the bottom, I do not have anything for the 1990s. That is because if we go back to this chart, if you take a look at the 90s, they just had this insane bull run. The S&P 500 never registered and oversold on the weekly. So therefore, you just be accumulating your cash throughout that whole time and kind of letting those previous shares you had bought just multiply if you're still holding on to them.